Hello, I'm Shane Vernier.
Hi, I'm Connor Woods.
And I'm Nick Quinn. We are the analyst team here at howtotrade.com, and together we're going to show you everything that you need to know about trading the inverse head and shoulders pattern. So let's get started. In technical analysis terms, an inverse head and shoulders is a very, very important pattern to know. It's a very simple pattern to see on a chart, and it's very popular to trade, and it's one of those basic setups that everybody in technical analysis should know about. They tend to occur at the bottom of downtrends. They are reversal patterns, so we're looking to move from a downtrend into an uptrend, and it's the neckline that is the absolute key factor in dictating whether the inverse head and shoulders has worked out or not. It has a shoulder on the left hand side, then the head, and then a shoulder on the right hand side. So it has a very distinct structure that's very easy to spot. So let's break down exactly what we would need to see to identify it properly. An inverse head and shoulders is a classic pattern in technical analysis and one that every trader should know. It's a very simple setup and is a reversal setup and is the opposite of a head and shoulders. Now, what we're looking for is one shoulder to be created down here, a second shoulder to be after the actual low of the move, and that would be our head down at the bottom there. Now, what we're looking for is the swing points that are created between the two shoulders and the head. That is what we define as our neckline. That's our level of resistance that we're looking to trade off if the market then moves higher from there and the reversal actually happens. The way that you would do that is you would look to buy the break of the neckline itself, or maybe a structural point, a candle close, something like that. The classic way to then actually project a profit target from there is to always measure the greatest distance of the pattern, which is usually the actual distance from the neckline to the head. Whatever that distance is, you would basically look as that as your target. That would be the way that we would interpret it from a profit taking point of view. Stop loss placement, that's debatable too. Some people will be very aggressive putting a stop on the other side of the neckline. Personally, I think there's a tendency to get flushed out to the downside first before we then create a classic entry, before we then carry on rallying. An alternative would be to put a stop loss, a more conservative stop loss, under one of the shoulders, one of those shoulder levels. But that is the basic setup, and that's how we would identify it on a price chart.
So let's have a look at how we can trade this inverse head and shoulders pattern. And the easiest way to do this is via a breakout strategy. And also you may want to confirm some levels with some Fibonacci retracement. So we're going to do exactly that. First of all, we want to try and identify this on this chart. And you can see when I get my drawings back up on the chart, we can see this inverse head and shoulders really taking place. So we've got this left shoulder here, which is that first initial down and retest, and then we have the head of the move we've got here, which is the more expansive move, and then we've got that right shoulder forming as well, and then we can see across the top there we've got our trend line, or our neckline, that we're looking for the market to break. Now if we're looking to trade the breakout way, simply what we're looking for is we're looking for this breakout candle above this neckline, which you can see that we've got here. And you can see that once we enter a long position after the breakout, we may want our stop losses maybe just sitting below the right shoulder, or some people have it below the head, but that would be quite a large stop loss. So let's say it was sitting below the right shoulder. You can see we've had this real breakout in the trend, and you can see that the market went and yielded pretty much a 2 risk reward trade. Now you may want to actually use the Fibonacci levels as well to really confirm your bias. So if we draw our Fibonacci from the top of the move all the way down to the bottom, you can see we've got these levels coming in now. Now what we may want to do is we may want to along the way wait for a retest of maybe the 50% level that we get here. Let's draw that so it's nice and clear. So once we've broken above, you can see this trend line and this neckline sits around this 38.2%, and in some cases you may be able to get a retest here. You can see that we did break above the 50% level, and then we went and retested that level. So maybe if you wanted to wait for the trade, you may want to enter on the retest of that with a stop loss just sitting below that 38.2%. And again, we still went and got just over a 2.4 risk reward trade, but it gave us more confirmation after that breakout along the way.
Okay, here are the pros and cons for the inverse head and shoulders pattern. First, the pros. With the inverse head and shoulders, you're dealing with an accurate and reliable charting pattern. Also, when trading the inverse head and shoulders pattern, your stop loss and take profit levels are well defined. So you do have a specific market entry and market exit point on each and every trade. Lastly, the pattern works well with Fibonacci levels. Now, there's one major drawback for the inverse head and shoulders. It can be complicated for beginner traders to identify the pattern. There is a bit of nuance and discretion involved in its interpretation from the live market. All right, let's take a look at some of the key takeaways from the inverse head and shoulders pattern. Number one, the inverse head and shoulders formation is a bullish reversal pattern that appears after a downward movement in price. Number two, to identify the inverse head and shoulders pattern, you need to find three bottoms after a bearish trend with the following components: a left shoulder, a head, and a right shoulder. Also, a trade can be made when price breaks above the neckline. A stop loss is placed at the lowest level of the right shoulder and a take profit above the pattern itself. Lastly, as a trading strategy, the inverse head and shoulders pattern works best in combination with Fibonacci levels. Now, if you want to learn more about the inverse head and shoulders pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you exactly how to fit the inverse head and shoulders pattern into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to practice and gain valuable market experience. Then, once you're ready, feel free to join our How to Trade Funded Trader program.